Hello everyone, welcome to INR Bond Search for Yields. I am Nikhil, and in today's topic, I'll be discussing about how should a fixed income investor could take benefits of the rising gold prices, and also by adding the corporate bond to the portfolio could stem the volatility, if any, in the future the gold prices incur in the portfolio. So this portfolio, we call it Goldilocks portfolio, and given the markets are very uncertain due to the escalating conflicts between the Russia, Ukraine, and the Fed is expected to raise interest rates in this coming next week policy meeting, and also due to the Western countries' sanctions on Russia is having a spiraling effect on the commodity markets. We have seen commodity prices, Brent crude, aluminum, copper, nickel, metals touching all-time highs. So which could lead to the higher inflation in the coming months. So all in together could have a possibly put a lot of pressure on the central bankers, and in turn could rise the interest rates at much faster pace than expected. So given this equities, we're seeing almost a 2 to 5% kind of a fall in every week, and also the government bonds, so the government securities, the benchmark are also seeing the sharp rise in the yields, which could lead to a drawdowns in the portfolios. So, given in this uncertain times, usually the investors take shelter in the safe haven assets, that is gold or USD. So the gold prices in the last 1 month, I have seen a sharp rise from 1700 level dollar per ounce to the $2,000 per ounce. So how can you take investments into the gold? So you can invest into the gold directly by buying a physical gold. However, it has a lot of cost and also have the risk of a theft and etc. But you can buy into the gold ETF. The gold ETFs are a passive investment instrument which have underlying related to the spot gold prices. The gold ETFs they represent 1 gram of physical gold and with the purity of 99.5%. And also the best part is you can also redeem your gold ETFs in physical gold from your AMC, and also you can use the gold ETFs as a collateral for the loans if you require any. And there is no risk of theft, as everything the gold ETFs are held in a Demat, and they're traded well on both the BSE and NSE exchanges. The bid and ask spread in the gold ETFs is much lower than compared to the sovereign gold bonds. So in the Goldilocks portfolio, we're going to have a combination of gold ETFs and a corporate bond with a better metrics, which can give you higher safety. So here we'll talk about a corporate bond. Let's just say corporate bond ABC. You can come on to our QuickInvest platform, which is available. The app is available in both in Play Store and App Store. You can come and choose the corporate bond. We have a curated list. We have narrowed down the corporate bonds in the shorter term. If you add a corporate bond which is of a longer maturity, that could bring in extra risk like duration. Since given the interest rate cycle is changing, the longer maturity bonds have a much higher duration risk. Since we prefer the shorter end maturity bonds, and we have several bonds, close to 20 bonds, which are having a different maturity and frequency of coupon payments. And for example, we have taken a bond which is giving us 8.5% returns in the next 2.5 years. So in the first 3 scenarios, 1 to 3, we have taken where the gold prices rising by 25%, 50%, 70% respectively. And the corporate bond yields, which will give if you hold till the maturity, the bond will give you 8.5% every year. So on a, we took a weighted, we are given as respective weights for the gold ETF and the corporate bond. To know more, contact us. We will help you with what weights we have taken in this scenario, in this example. So we are seeing a returns of ranging from, even if the gold price rise by 25%, and in the next 2.5 years, and the corporate bond giving you 8.5%, the portfolio should yield you 8.77%. And in the best scenario, the gold price rise by 75% from current levels, the whole portfolio will give you a 17% annualized yields. That is a 16.31% CAGR. In the worst case scenario, that is scenario 4 and 5, the gold prices fall by 25% or 11% annualized, then the portfolio still give you a 3.26 annualized returns for the next 2.5 years. And the last is a scenario 5, where we are seeing a gold prices falling by 50%, that is at 25% or 24% CAGR from now. The portfolio will still give you a positive returns, that is slightly 0.34%. So here the point is, even in the worst scenario, the whole portfolio, the Goldilocks portfolio would yield a positive returns. But given this uncertain markets, the safe haven asset, the gold is seeing a lot of traction. In the gold prices are rising; it is at new highs. So the investors could take benefits from the rising gold prices, and also add a safer corporate bond which can shield you from the falling, if at all the gold prices fall. So the permutation combination here is you can just have a number of corporate bonds, or different coupon paying, like the frequency is monthly. We have a monthly paying coupon or a quarterly paying coupon. You can reinvest that money into either into the equities or any other asset if you want to time the markets. And this is our benefits of QuickInvest. If you want to invest through our QuickInvest platform, the choosing of the bonds will become much easier for you, because we have already narrowed down to the best 20 bonds which are available on our order book, and the process is much simple. You can download it on your phone and just buy it with just one single click. And if you find this video useful, do give us a like and subscribe to our channel, and check out our platform, and let us know what you think. Give us your feedback. Thank you for listening in. Signing off.